In the meantime, let's have a conversation with Robert Schein, CIO of Blanke Schein Wealth Management, who joins us live. Morning, Robert. Thanks for being with us.
Great to be here.
Look, I'm just reading one of the comments that you made earlier on, where you say investors are clearly underestimating the potential issues that may arise from a structurally higher cost of capital environment. Just add some flesh to that comment for me, please.
Absolutely. If we're looking at all across the equity spectrum, the capital spectrum, the cost of carrying, right, the debt cost, because rates are up so high, not only just for the consumer here in the U.S., but across the world, that's going to eat into earnings. That's where we have to be cautious in this market, when then we'll sort of vet out those that actually have solid balance sheets, whether it's a corporation or a country, and those that actually is a weak hand, if you will, and needs some support.
On that front, though, a lot of the S&P 500, I hate using this term, I hate it, but they're immunized in some respects because of the term maturity that they have. But do you think enough attention has been shone on the fact that it's really realistically SMEs in the United States that are going to have to deal with the increase in rates, and they're the ones that are most exposed. They're the ones that have the lines of credit that they need to continue to have, whether they were getting it at, a little bit over prime when it was at zero. Now they're looking at perhaps 6, 7, 8, 9%, and they constitute so much of the economy. Do you think that that's being overlooked?
It is, but like anything else, if you were to look at the private commercial debt right now, earlier this year in March, the small regional banks were challenged. They obviously had to shore up their own footing. But what we're also seeing is private credit come into this market like we've never seen before. So there is going to be, I think the take-home point here is whether it's not going to be from the local regional bank here in the U.S. for commercial real estate, but whether it's short-term capital management or even mezzanine loans or even long-term debt, it's the private credit, which is interesting. Now, that's at a higher rate, and that's what I was talking about earlier, which is the yields are super high right now, and so hopefully this is sort of like, let's set it for a couple of years and then refinance in a future. Let's say if we have a recession in the U.S., I think a lot of people are hoping for sort of lower rates in the future, but we're on the heels of Jackson Hole last week, and Chairman Powell was very specific when he said higher rates for longer, and that's sort of, we had a relief rally in the last 48 hours in the U.S. and here in China, but I think, once we settle in towards month-end rebalancing, we're going to have a sort of a wait-and-see environment in September and reassess.
Yeah, and that's what I mean, because we were just talking to Andrew Slimman from Morgan Stanley. He was pointing to the fact that, you're going to have all of these fiscal taps being turned on. The S&P is probably going to get closer to 5K than 4K. But just to develop on the point that we were both making just then, in terms of, because we can talk about the S&P, we can talk about, the incredibly strong balance sheets that they have, but a lot of their customers are going to be the smaller businesses in the United States. They're going to be the consumers that are, if they don't have, their own home and they're locked in, they're going to be feeling the pinch. So when you put all that together, what is your expectation on not just market performance, but, and I hate to ask you this, but just in terms of timing, when you think we are going to start to see the significant cracks starting to come through?
If we go back to COVID, no one would have thought that the S&P or corporate America would have performed as well as they did when the whole world was shut down and supply chains were redirected. And now we're coming out of that, 2.5, 3, 4 years later now, and now we're talking about a potential recession or even higher rates. I think what we've learned and what we have to understand is corporate America, a lot of the companies, or the larger companies, are with quality balance sheets, are, could handle the good and the bad, economically speaking, by quick and fast and reaction times, whether it's laying off or whether it's ramping up, depending upon the economic winds that we're seeing. It's the consumer on the side that I think we should be concerned with, right? 2/3 of the U.S. economy is driven by the U.S. consumer. If we look at the retail debt right now, it's at an all-time high. So I think that's one of the keys that we have to pay attention to, is how much can the consumer, do they continue to go in debt? Or they continue to using, drawing down on resources. But corporate America, I mean, I would bet on corporate America versus the U.S. Treasury right now, and because some of these companies are just cash flow positive and their balance sheets are solid.
And presumably, because of the pain the consumer is feeling and will continue to feel, that's why you're picking Walmart as one of your stocks.
Yeah, Walmart is a company where it's a good economy, a bad economy. They can execute, and they've proven that. But if you look at the economy right now, the trade-down effect, the theme is back to school and sort of the value of the consumer. It's a $39 billion industry, back to school in the U.S. that can't be ignored. But this year, because of inflation, it's $200 more per child. We're a household of 4. That's a lot of money, and every consumer around right now is looking for just some relief. So Walmart will play into that. Their e-commerce game, as we've learned from their earnings report, is really ramping up. So they've done an excellent job in execution there.
Robert, we're going to have to leave. Apologies. We're going to have to leave it there. We're flat out of time. I really do appreciate you making the time for us today, though. That was Robert Schein of Blanke Schein Wealth Management.